Hello, hello. Joel Fiesel, your financial agent for life insurance and annuities. Today, I'm going to talk about a strategy. It's actually a life insurance strategy that also could incorporate an annuity. And so, for those of you that are looking for life insurance and maybe your health is not great, or maybe you're much older and also have bad health, and when you start looking at the cost of the life insurance versus what you're paying into it over a period of time, then you start thinking, well, gosh, is this really worth it? And so I want to talk about a strategy that I've used that some cases it may work better for you. And it's just a thought. Okay, I'm just throwing out ideas. I always say that when I go over information with my clients, I say I'm going to show you some options, what's available, and you find what works best for your situation. So let me explain how this works. So like again, most cases where this is really going to come into play is if you're much older, probably in your 70s and in bad health. Maybe there's some people a little bit younger than that, but that's where 70s and above where this is probably going to come into play more. So basically, at this point, you look at a whole life policy. And when you're looking at a whole life policy, there's going to be a point if you live too long where sounds terrible, right? Where you've paid more into the policy than what the death benefit is worth. And so, the question always becomes then at that point, well, when are you going to die, right? So, because we're talking about mitigating risk in a ways because you're wanting to leave a death benefit to cover, burial or whichever for your family. So then the question is, gosh, it'd be so much easier to know when we were going to die. So then you can plan much easier. But then, again, the downside is, well, now you know when you're going to die, and then it's probably going to terrify you, and so you're going to stay up at night with anxiety. But that's a whole other story, right? So in death fund, just kidding, talking about it. So then the strategy is, then the thought process is, well, shoot, gosh, I'm paying this into it. Well, maybe I should just save this money. Well, we have an option using an annuity to where you can actually pay into it on a monthly basis. And it's actually an indexed annuity. So that means it protects your money from any stock market loss. Your principal is protected. It locks in the interest once a year when the markets have a good year. When the markets are positive, you lock in interest. Once the interest is locked in, it's that's your new starting point. You never go below that. Okay. And we even have them with no fees. So in cases, like I had one that I was working on today actually, and I had a client that was looking to purchase, um, some coverage for their dad. They were going to pay for it, and so the cost was a lot higher on the life insurance. And then I said, well, maybe we should look at a way to save it in an annuity, and with the accumulation from the annuity, there's going to be a point where it's going to pay out more money if your dad lives too long, right? So basically, what we kind of talked about is, well, if he dies sooner, well then if you could split it, right? You could do a portion of the money that you're planning to use to get life insurance, a portion of it for life insurance, and the other portion towards an annuity. So where if he dies sooner, it pays out something now. But once it gets, and then you start up the annuity to where if he lives if he lives longer, too long, right? If he lives longer, then the annuity will accumulate more money than the death benefit would pay out. And so then it would pay out a larger amount. And then you could even, there's a point too where there'll be where kind of like the threshold, right? So where the life insurance, where, or excuse me, the annuity, where you've paid into the annuity, where it's going to pass the death benefit for the life insurance. And so then at that point, you could even cancel or surrender the life insurance policy. And if it's a whole life policy, then it would have some cash value. You can even put it into the annuity, and then to even make the annuity death benefit bigger. And so with an annuity, you can assign a beneficiary. So in this case, like this person was buying it for their dad. So the dad would be the annuitant, they would be the owner and the beneficiary. And so we even talked about setting it up as a Roth, since he doesn't have a Roth IRA and he's not contributing to one, to where as long as that money's in there for at least 5 years and then he passes, well, then all the interest earned is tax-free to the beneficiary. So To me, it made a lot of sense in this situation to use this strategy. So you can do variations of this. Some cases you might do, kind of a hybrid, a combination of both. In other cases, you might go, well, health is not very good. My health is not good. I'm not going to make it long. So yeah, we'll just do the whole life policy. In other cases, well, I'm going to live for a long time. Let's just put the cash in there. I'll sign a beneficiary that'll go right to my family members. So this is just a strategy that I've used time to time just to provide options, to find something that can work for different clients' particular needs. This might be a strategy that works for you. Not every company out there offers an annuity that you can pay into on a monthly basis. There's very few. We are a broker for one. So an annuity broker, that is. So if you are looking for that type of situation, you can direct message me, shoot me a message, and I'll be happy to help you. If you like information like this, make sure you like this video and subscribe to my channel. With that being said, we'll see you next time. Bye bye for now.